what I'm going to talk about. It's a slow grind that's going to be happening next year. So that's growth, but not growth in the sense that we've seen in the past. So with the pre-crisis levels globally, right, 5%, 4.5%, those days are not ahead of us. That said, it's not such a bad outlook. We do expect global growth to pick up somewhat. In the 3.5, approaching the 4 range. We've had sort of a slow slog, and that's likely to continue. And part of the reason that we're not seeing sort of the big growth we saw pre-crisis is that the drivers of the growth are starting to change. So the U.S., which for a long time had a really slow recovery, is actually expected to accelerate in growth next year, based on strong domestic demand and just a general strong recovery at long last in the U.S. Conversely, though, China, which has for a long time been sort of the main driver of global growth, is actually expected to see a slight slowdown as there's a readjustment and realignment internally. So without China really pushing ahead that global growth number, we're going to see that sort of more gradual grind in growth that I described in the previous slide. And the reason that China is not the big driver globally that it has been in the past is that you're seeing a bit of a rebalancing internally. So this slide just compares the main components of the Chinese economy with some other countries, the US and Germany specifically. So the big thing to look at here is that within China, private consumption as a share of the total GDP is still extremely low compared to other countries like the US. And so as you see a rebalancing within the economy, as you shift from that investment-led growth that we've seen over the past 10 or so years to a more consumption-led economy, just mathematically, because of the small current share, you're going to see a slight deceleration in growth. But this is overall a positive development for the Chinese economy and for the global economy, because the consumption-led growth is a bit more durable, and we have seen maybe some signs of overinvestment in China. And in line with this, there's also an expectation of a slight correction in the property market. Again, a positive development. We've seen large booms there and sort of a more normalization in the coming year. So we'll turn now to the US, our biggest trading partner. So our expectation for the US is generally quite positive. So as the graph here shows, you've seen really a mixed bag of performance post-crisis, 2010 onwards. A lot of these are one-time events, the shutdown, the sequestration, things like that. But the US seems like it's really finally primed for steady, positive growth, which of course is going to be very positive for Canada itself, as the US is our largest trading partner. Unfortunately, although the growth is positive and was expected to be sustainable, it will be a bit lower than what we've seen in the past. So this is something we've seen across all countries, including Canada, the Eurozone, and most advanced economies, is that the long-term trend growth, we refer to as potential growth. So this is sort of the idea of what would the economy grow at if there were no frictions, if everything was sort of perfectly in an imaginary model. And in the past, the US has been growing about 3%. Unfortunately, we expect the potential growth rate to be just below 2% going forward, which is still positive and still a respectable growth rate. But the strong growth that we saw in the US, the 80s and 90s and even the aughts, those days are behind us, unfortunately. Just to speak quickly to the US dollar, and I'll come back to exchange rates in some subsequent slides. The US, because of the strong growth, has actually been experiencing a real resurgence, a real strength in the dollar. So we've shown the yen here as well as against the euro, just to show the more broad-based currencies. But this is true across all major currencies. So as the US is finally exiting the doldrums of slow growth, and growth expectations are picking up, quantitative easing is coming to an end, things are normalizing there, you're seeing that reflected in the strong US dollar. And of course, conversely, weaker currencies for Canada, euros, and others. So I get to the meat of the presentation, which is, of course, Canada and Ontario and Toronto. So Canada, we're describing it as, we're healing, but there's still a lot of baggage. So the Canadian economy is improving, but there's still a lot of lingering downward forces from the crisis. In terms of growth, we expect the Canadian economy to average growth of about 2.5% to 3% over the coming year. And that's in line with the US growth outlook. As I'm sure everyone here knows already, there's a very strong relationship between the Canadian growth and the US growth based primarily on trade linkages. So we're really going to benefit from that strong recovery in the US that I described in the earlier slides. This is reflected, of course, in our forecast for exports. So as you can see here, the oil production is expected to stay relatively flat, but exports are going to pick up. So we're expecting a real positive development for the non-oil exports. So, produced goods, manufactured goods, foods, all the sort of traditional Canadian exports, excluding oil. Of course, oil will still be a factor, but we really do think there'll be a pickup more broadly in the export picture, and that's supported by that strong US dollar, which of course means a weak Canadian dollar, pardon me. And returning to the currency, we don't really think there's much upside for the dollar vis-a-vis the US currency. So right now we have an expected forecast of about 87 cents, picking up to about 90 cents over the coming year, and staying broadly in that range. So the current favorable exchange rates that we're experiencing, we think that they're here to last well into next year and the year after that. Just looking at other currencies, we expect a similar picture here as well. So the Canadian dollar against the US dollar, which I've already shown, and of course the Chinese yuan, are expected to stay broadly flat. So we don't see any major movements against major currencies, with the exception of the euro, which of course has its own idiosyncratic factors going on there, but their recovery should lead to a strengthening there. So in terms of the growth mix, I spoke about about exports as one of the drivers. We also expect consumption to remain a positive driver. So people are expected to continue to spend. We've seen an improving labor market. We've seen improving household net worth. These are all the fundamental drivers that will get consumers out into the stores, out into the malls, and opening their wallets. So that remains a major driver of the Canadian economy into 2015 and 2016. We do expect some deceleration, of course, but there's still very positive numbers, very strong numbers, particularly in that post-crisis sort of context. One area where we won't see any growth is in government spending, at least not at the provincial level. So what this shows here is the federal deficit, which under the current government has drastically improved. We saw a huge increase due to the stimulus in 09-10 fiscal years, and the government has made great progress in paying down that deficit, and these numbers are actually slightly out of date because we are actually projecting a slight surplus for the coming year, and that's consistent with recent government announcements. On the flip side of that, unfortunately, you're going to see a lot of restraint at the provincial level, and Ontario in particular is dealing with a very significant debt burden. So you're going to see a lot of constraint in terms of government spending on things like infrastructure projects and other government projects. In terms of the inflation outlook, which is, as a former Bank of Canada employee, something near and dear to my heart, there's really not much concern here. We expect inflation to return to 2% over the course of about the next year and a half. There's not a lot of fundamental drivers that will push us away from that target. The economy is slowly returning to its potential growth rate that I described earlier, and that's going to result in inflation sort of in line with the Bank of Canada's target of about 2%. And speaking of the Bank of Canada, we also expect that the Bank of Canada's policy rate, and which of course sets the broader interest rates through the economy, will remain at its current rate of 1% until the third quarter of next year. So we don't expect them to make any moves until about September, October of 2015. So they're expected to move sort of slightly after the Federal Reserve and move in line. And this, of course, also feeds back into the exchange rate forecast. Because we expect the Bank of Canada to move more or less in line with the Federal Reserve, that should reduce pressure on the Canadian dollar one way or the other, which should keep it, again, trading in that sort of 87 to 90 cent range. Drilling down a bit further, looking at the provincial growth outlook, for 2014-2015, we expect there to be a bit more of a convergence of the growth rates. Alberta's obviously still going to be the leader in growth in Canada, well above average, but we do expect to see a significant pickup in Ontario in terms of GDP growth. relative to 2013. So we're talking growth rates in line with the average at that 2.5% growth rate. So not shockingly strong numbers, not boom numbers, but these are solid, respectable numbers for an advanced economy. So again, it's sort of a return to normality. I think is sort of the theme that you can think of here in terms of growth, particularly in Ontario. Drilling down further, in Ontario, Toronto and the Greater Toronto Area is expected to be the fastest growing area, major metropolitan area within the province. There's a lot of good fundamentals driving Toronto. You've lots of hiring, lots of construction. So you're going to see a nice strong growth in Toronto, well above that 2.5% growth rate. So it's a positive picture looking forward for the Toronto area. In terms of the labor market, continuing the theme, it's going to be a slow and steady improvement. So we expect, this is Ontario in particular here, so we expect employment gains to continue. So not strong, but growth of 0.5% to 1%, which in terms of absolute employment is a relatively respectable number, and a continuing decline in the unemployment rate. So generally a strong, steady recovery in terms of the Ontario labor market. And just to speak to Toronto specifically, that story in terms of improvement should feed through to the Toronto area as well. So Toronto tends to have a slightly higher unemployment rate than Ontario, and conversely than Canada, as you can see here. And that's due to a number of structural factors, but they do move very closely together. So those improvements that you're going to see in the overall job market are going to translate into the Toronto job market. And again, improving labor market translates into improved growth, improved spending. So it's generally a positive story for the GTA. One caveat that's come up a little bit in the media is that a lot of the job growth recently has been part-time. So if we look at the leftmost paragraphs show the average growth in jobs in the period leading up to 2013, and you see a mix between the full and part-time. Within 2014, you've seen a really big jump in the part-time job growth. This is a trend that we expect to peter off, and we do expect that as the recovery takes hold, you'll see more and more full-time jobs. And again, that's a positive development because people with full-time jobs obviously spend more, do more economic activities. So it's something to keep in mind that as a slight headwind in terms of that mix, but it is not something we expect to persist. And the one thing that everyone seems worried about in Canada is debt, household debt, which is still extremely high. We're talking above 160% of personal income nationwide. But the fortunate thing is that it's stabilized. So this period we saw sort of, from through the aughts into recently of this rapid increase in household debts, that's come to an end, and we don't expect that to come back. So we expect the household debt to still remain high. This is still a concern. Obviously, these numbers are very high, particularly in an international context. But that ramping up that we've seen, that's expected to decline. And household debt growth is also expected to moderate. So in that 4% range, which still seems high, but is much better than, say, the 12% that we would have seen in the pre-crisis area. So again, a positive development. Households aren't going in as much debt. The net worth is improving. All these things are going to be positive developments in terms of the consumption outlook. So everyone loves the housing market, so do I, so we'll turn there. So we start nationally. So this graph shows the sales to listings ratio. So it's the number of sales in a given period versus the number of listings. So if you're putting your house on and it sells immediately, that would give you a value of 1. If you can't sell it at all, it's 0. So the higher the number, the better it is for the seller. They have more power because there's a high demand. And the lower, the better for the buyers. We expect to see a balanced housing market nationally. We've seen this essentially since the beginning of 2011, that the housing market sort of normalized in this, about the 50% range. And that's expected to continue, and with a slight trend towards the buyer's market, but remaining broadly in balance at a national level. However, that's against the backdrop of, again, national house prices declining over the coming year. So this is across all housing types and across the country. So there's been some overbuilds in certain areas, a lot of overexuberance in certain areas as well. So on a national basis, we do expect home price growth to actually go slightly negative towards the end of next year and into 2016. So it's just a bit of, again, a normalization is that word I keep coming back to. So it's a bit of normalization of the housing market within Canada itself, where we've seen a bit of froth, particularly in certain markets. But if we look at the GTA, which, as I'm sure everyone here knows, has had a bit of a boom itself, this is that same graph of sales to listings I showed before. And this just compares Toronto against Vancouver and Calgary. So Toronto very much remains in that the top of the balanced market, bottom of the seller's market sort of range. So if you're someone that bought a house or a condo in Toronto, this is it's not a bad place to be, right? There's still high demand for housing in the area, and that's a good thing if you're a homeowner, and bodes well for investment in real estate as well. We see this as well in the house prices. So we don't have the forecast included here, but the Toronto single-family home prices and the condo prices have both seen very positive growth price developments in the year to date. So the single-family homes in particular have seen growth rates well above the Canadian average, and even the condo market has seen growth rates in line with the broader Canadian average, which of course includes non-condo sales. In terms of, is it a bubble? Right, it's a question that comes up often. Well, this graph is a bit scary. So this is the home price to rent ratio, and we've indexed this. So this, as you can see, the green line there is Toronto, and it's poking its head up above everyone else. It's well above, say, the Vancouver rate, where it's another city that's seen really significant price gains, and well above the national rate as well. So that would probably give you cause for concern. But the old joke goes that if you ask two economists the same question, you'll get two different answers. So if you switch this and look at the house price to income ratio, which is a slightly different measure, you see Toronto's actually not as terrifying. And that's because the people in Toronto tend to earn more money than in other cities. So when you compare the prices to what people are actually making, it's really not as frightening of a picture. So Toronto is slightly above the Canadian average, and that's sort of gapped out and widened since about 2010. But it's not terrifyingly so. These aren't cause for concern. It's certainly not in the same way that, say, the Vancouver housing market would be an issue. Turning to home sales. So home sales have rebounded in most areas in Ontario this year. So Toronto has seen a rebound of about 3% growth in home sales, and that's well above the provincial average. So again, just reiterating that the real estate market here, on the face of it, appears to remain still robust. Turning to the payments, again, the same story. So the long run average goes across the top, and these are payments as a percent of your household income. So right now, household payments are about 30% on average of household income in Toronto. That's expected to pick up slightly, but remains in that range. So we're not talking about housing becoming unaffordable broadly. There'll still be strong demand for housing within the GTA. One issue for concern, particularly in the GTA, is affordability of houses. So single-family homes are becoming increasingly unaffordable for the majority of Torontonians. And that's in part because the simple fact that you just can't really build many more houses in the area. We're sort of running out of land. So condos are going to sort of fill in the gap. So we have a lot of condos coming on stream. I believe there's on the neighborhood of 70,000 condo units coming into the Toronto market over the next 2 years. So that'll help keep the housing affordable for Torontonians. Unfortunately, single-family homes are becoming increasingly challenging. So I'll wrap it up here and leave a few minutes for questions and answers. So just to speak quickly about the economic outlook more broadly. So there are a few downsides to what I presented. We have this 2.5% growth. So there's the chance that some geopolitical developments may intensify. We have things going on in the Middle East, going on in Ukraine, other places. The economic rebalancing in China, we expect that to occur fairly smoothly, right? That shift from investment to consumption. There is a risk that does not go as smoothly as we've anticipated, and that's going to have a big impact on Canadian export demand and global growth more broadly. Japan and Europe have been a concern for quite some time, and there's still a chance that you may return to stagnation there. And there's a chance of renewed market volatility. I mentioned the Federal Reserve is ending their quantitative easing program. So there's a chance that you may see some turbulence in financial markets as the date approaches and the interest rates start rising. On the other hand, of course, there's also upside risks. We have the US economy growing quite robustly. It's possible, though, that the US economy may recover even more strongly than what we have. So the housing market there may pick up more quickly, and that would give us stronger growth, and that would also be very positive for Canada itself. It's also possible that the quantitative easing programs, both in Europe and in Japan, which recently expanded their program, could surprise on the upside. So you might see some more growth there, and maybe more demand for Canadian goods on the global market. So I'd like to end it there, and thank you for your time, and take any questions that you might have.
Thank you. Thank you so much.